Let's take a look at a specific market. Let's say we're trading with Japan and we want to trade dollars for yen or yen for dollars. There needs to be a market for that to take place. So we have a demand, we have a supply, we have a quantity, and we have a price. Understanding how the markets work is very much determined upon getting the labels on these curves correct. So let's say we're dealing with dollars. We have a demand for dollars, which is a downward sloping curve. We have a supply of dollars, which is an upward sloping curve. We have a quantity of dollars on our quantity axis. And where things get a little bit weird is what happens to the label on the price axis. The label itself is known as an exchange rate, but we want to make sure that we're exchanging things properly. So when we're looking at the market for dollars, where the demand and the supply of dollars is what's being examined here, the label on the price axis is the price of dollars, but it's the price of dollars in terms of the other currency, in this case, in terms of yen. So we have a demand for dollars, a supply of dollars, a quantity of dollars, and the price of dollars in terms of yen. How many yen do you need to buy $1? And that's how the market is set up. Wherever the two lines cross, we have an equilibrium. Now, the thing about that equilibrium is that it doesn't have to stay there forever. Just like any other market, if something comes in and changes the demand and supply curve, it alters the position of the curves and alters the position of the equilibrium. Specifically, if demand increases or if supply decreases, it's going to cause the price of dollars in terms of yen to go up. In other words, it's going to cost more yen to buy a dollar. This is sometimes referred to as the dollar strengthening, or getting stronger, or appreciating. And a lot of times we think, well, this is a very good thing. We want our dollar to be strong in the world. Perhaps, but perhaps not. We'll get back to that in just a second. If demand decreases or if supply increases, that would cause the price to fall. In this case, we're saying that the dollar is getting weaker against the yen. It's depreciating. And you say, well, that's got to be a bad thing. Well, maybe it is, maybe it isn't. Let's take a look at that. One of the reasons that it's important to understand the exchange rates of currencies is because it is very instrumentally linked to trade and how trade takes place. Whenever we trade with another country, as I said before, we need to buy their currency. And you can buy more currency, you can buy more yen if your dollar is stronger. Let's say that the exchange rate is $1 for 100 yen. If the dollar gets stronger, maybe it becomes $1 for 200 yen. So you can buy more currency. And that sounds like a great thing. But there is a dark side to this, if you will. If we can buy more yen, it also means we can buy more Japanese products for a lower price. Think about it this way. Let's say that there's a camera that you want to buy from Japan that costs 1,000 yen. If the exchange rate is 100 yen to a dollar, that means it costs $10 or 1,000 yen. If the dollar gets stronger, let's say we can buy 200 yen with $1. That means that 1,000 yen camera now costs you only $5. This is good for you because you can buy the camera at a lower price. And so, what do you think is going to happen? If people want to buy cameras, they're going to buy them from Japan because the price has gone down. If U.S. citizens want to buy those products, they seem relatively cheaper, so we buy more cameras from Japan and many fewer from the United States, which means our imports go up. Our exports, on the other hand, is going down, and that's where we have to pay close attention. If the dollar is getting stronger against the yen, it is necessary that the yen gets weaker against the dollar. So as one currency appreciates, the currency you're comparing it to must necessarily depreciate. So if we're buying more cameras from Japan, then Japan is going to be able to buy fewer things from the United States. think about it from the Japanese perspective. If the trade-off is $1 equals 100 yen, and then the trade-off changes to $1 equals 200 yen, that means it's getting more expensive for Japanese citizens to buy a dollar. If they don't buy as many dollars, they can't buy as many US products. So our exports go down. The question is, do you want a strong dollar? A strong dollar is a nice thing. But there are trade ramifications for this. Do you want a weak dollar? A weak dollar would mean people would buy more of our products from overseas because our exports would become relatively cheaper and their imports would become relatively more expensive. So we would buy fewer goods from overseas and sell more overseas.